David, can we just do a check on my mic if that's okay?
Yes, I can hear you. Sound good.
Thank you.
That was good, Dan.
Can you hear me?
Yes, I can. And your well, it's a blue screen, not a green screen, but it is working.
Perfect. Thank you.
Good. All right. Let's go ahead and get started with our third and final session of our stakeholder forum. Thank you all for joining us, especially those of you who have been with us since the beginning. You're soldiers, and I applaud you. So we've come now to our third session. As you can see, it's on the asset liability management cycle. And I'm going to turn it over to our moderator for the session, Kelly Fox, the Chief of CalPERS Office of Stakeholder Relations. Go ahead, Kelly.
All right, thank you again, David. And thank you all for your participation today. We appreciate that very much. We have kind of an all-star cast here of CalPERS team members who will be presenting this session, our asset liability management cycle. We'll be joined by our Chief Financial Officer, Michael Cohen, our Interim Chief Investment Officer, Mr. Dan Bienvenu, our Chief Actuary, Mr. Scott Turando, one of our Managing Investment Directors, Mr. Sterling Gunn, a new addition to CalPERS, and then one of our investment managers, Lauren Rossborough-Watt. So without any further delay here, we want to talk a little bit about the asset liability management cycle here, explain it to everybody, give you some background, and give you the opportunity to learn about it and to ask questions if necessary. Again, we would remind you at the bottom of the screen, we have a Q&A section where you can ask your questions. We have a chat where you can introduce your question and we can read it on your behalf. There's a raise hand so we can call on you. And if you're on the phone at the end, we can also have you add additional public comment if needed. So thank you very much again for participating, and I'm going to turn it over first to Mr. Michael Cohen.
Thanks, Kelly, and good afternoon, everybody, and thanks for joining us. So the session is about understanding the ALM process. So just so that everyone has the objectives in a common understanding today, we hope that you understand what ALM stands for, and then second, that you know what to expect in the coming year. For those of you who've been watching CalPERS over the past year or so, we've been talking about 2021 as being the big year for the ALM process. This is something we do every 4 years, and we're now into 2021. So here we go. If we start the next slide, David. So what is the ALM process? It's really, in short terms, making sure that our long-term assets are matched up with our long-term liabilities. That does involve many facets of the CalPERS organization. You'll be hearing from a number of us today. The assets of asset liability management is really rests with the investment office. They're the ones who invest the over $400 billion of assets that CalPERS has on hand. The liability you'll hear from the actuaries in terms of what the system will cost over the long term. And then finally, the management, that's really my role representing the financial office to make sure that all parties are sort of communicating with each other, we're communicating with our stakeholders, and that we're speaking in one transparent and comprehensive manner as we go through this. And so if we, David, you can get us to the next slide. Really, this process is embedded in the state's constitution in terms of this being, as a pension fund, our constitutional obligation, meeting our fiduciary responsibilities to make sure that our pension system is sustainable for the long term. So with that, to the next slide, really this kind of lays out the key pieces of the asset liability management cycle. First of all, the objectives. That really, as I just mentioned, rests from our constitutional authorities, where first of all, we're trying to make sure that we do everything in our power to meet the promises that our member government agencies have made to our individual members and retirees. But in doing so, trying to make sure that the system is as least expensive as possible so that we have contribution stability from our government agencies as well as our members, and we reduce the employer contributions to the greatest extent possible. everything within a pension system comes with risks. And really this asset liability management is a good chance for the organization to step back and assess the risks that we all know are there and really understand them to the greatest extent possible. We're never going to be able to completely eliminate risks. When you're investing $400 billion, it's going to come with some risk, but we want to at least understand it as best we can, and then make decisions based on our understanding of those risks. And finally, and perhaps most importantly, the outcomes of this process. What can you expect by the end of 2021? Really, there's two things. One is we end up with this strategic asset allocation for how we're going to divvy up our investment proceeds and how we're going to invest them. And then two, what will be the discount rate? You'll hear about the discount rate more from Scott a little bit later, but ultimately that's sort of the assumption that drives all of the rest of our liabilities and assumptions about our future growth in assets. And throughout this entire process, it is set up to really have opportunities for all of you to continue to provide input to us, to provide insight, your priorities, what you're concerned about, your comments on what we're doing. And as we go along, you'll see there's going to be plenty of opportunities beyond just today to provide the CalPERS team and the CalPERS board with your input. So to the next slide, this is really a nice slide that just sort of summarizes everything I've mentioned already, that you've got the investment office, the actuarial office, and the financial office working together. And then we really do rely on Kelly and David representing the stakeholder relations branch to get that out to our community and make sure that you have the information you need to provide the board with effective feedback. And then ultimately out of that, as I mentioned, we end up with our strategic allocation as well as a discount rate. So on the next slide, this is really a snapshot of the upcoming ALM process. You'll see items in February, June, and July, as well as then leading towards a decision towards the end of 2021 in terms of the calendar year. So we'll come back to this at the end, but coming up here, the next opportunity to engage with the ALM process will really be through our investment committee at the February board meeting. So with that, let me pause here and check in with Kelly and David if we have any questions or comments at this point.
Thanks, Michael. So folks, again, if you have any questions or comments, go ahead and hit that raise hand button or type in your questions in the Q&A box at the bottom of your screen. Give a moment here. Michael, I'm not seeing any questions at this time.
Very, very good. Hopefully that was clear in terms of what the ALM process is trying to do. And with that, I'm going to turn it over to the investment team, starting with Dan Bienvenu.
All right. Thanks, Michael. And as Michael mentioned earlier, the first letter there in the ALM process is the A for the assets. And so that's what I'll be leading this off on. And I think the place to start really is the role that the investment office plays, in achieving CalPERS mission, which is, as Michael said, CalPERS is here, of course, to service the retirement of 2 million members. And the investment office within that, our role is to manage the investments, the $400 billion portfolio. So we'll start our discussion with sharing our mission and our vision statements that underscore that management of the portfolio. From there, we'll move on to the performance of the total portfolio and the asset classes and the role that each of those asset classes plays in the total fund. We'll start with our long-term returns as we go through performance, because that's our focus, and then we'll move to a one-year snapshot of the portfolio and the performance. And from there, we'll talk about strategic asset allocation. We'll transition to Lauren Rossborough-Watt and to Sterling Gunn, who will take us through the current financial landscape and expectation for returns going forward. And then we'll end the discussion talking about two distinct areas of focus in our investment strategy. First, our focus on capabilities and deployment in the private asset space. And then second, our exploration of the strategic use of leverage to boost expected returns. And then we'll talk about how it all comes together into a portfolio context. All right, so it looks like we've got our mission and our vision up there. So as I mentioned, I'll start with our mission and our vision statements. And our mission and our vision statements really were created in alignment with and intended to support the CalPERS enterprise mission and vision statements, as well as the strategic plan. And given that the investment office's role in delivering the benefits to our 2 million members is to manage the portfolio, the investment office mission and vision statements are intended to remind us first why we exist, the mission, but also how we're going to accomplish what we're trying to accomplish, which is the vision. And the mission was written as follows: to manage the CalPERS investment portfolio in an efficient and risk-aware manner to generate returns to sustainably pay benefits. Now, risk-aware encompasses our two investment beliefs on risk, namely that risk is multifaceted and that we'll only take risk where we'll be rewarded for it. But it also has risk-aware in there intentionally to remind us that meeting the assumed rate of return requires risk-taking. We know we can't do it without taking risk. The key is that we want to make sure that we're taking prudent risks and they're risks that we believe will be compensated for taking. And the word sustainably was also purposefully added in recognition of our virtually perpetual investment horizon, as our job is to create returns for generations to come. So as mentioned, the mission is the what and the vision is the how. And here we wrote our vision statement to be as follows: to work as one team with a culture of trust, respect, and accountability to effectively manage one total fund. Now, one team reflects our desired culture of collaboration and teamwork. We all have different roles in the investment office, but each role is critical in the management of the total portfolio, and we work as a team to achieve the mission. Trust, respect, and accountability are key traits that we want reflected in our culture. And then finally, one total fund reflects two main concepts. First, the total fund is both the Public Employee Retirement Fund, or the PERF, and also the affiliate portfolios, such as the healthcare and pension pre-funding trusts, as well as the defined contribution plans we manage. And second, the things that happen in the various parts of the portfolio, while critical, are only critical because they support the total portfolio, because it's the total portfolio that pays the benefits. And that one team, one fund vision is really important for us. So if we could get the next slide, please. All right, so now let's move on to the returns we've generated, and we'll start with our long-term returns because, as mentioned, this is our area of focus. And the reason that we focus here is several reasons, but I'll highlight three of them. First, our liabilities, or the benefits we pay out, are measured in decades and generations, and our investment horizon and focus should align with our liabilities. Secondly, short-term performance can be very noisy and can lead to inaccurate conclusions if taken out of context. All performance measurement can be skewed by the time period used, but short-term performance is especially subject to these potentially misleading conclusions. And finally, being a long horizon investor can be a real structural advantage for CalPERS, and we don't want to squander that advantage. We have to act like a long-term investor and keep that as our focus in order to use that competitive advantage. Now, certainly we do look at shorter term numbers and we analyze our performance on a nearly real-time basis to be sure we're taking risks that we want to be taking and prudent risks. But it is important to keep short-term performance in perspective, as our true nature is that of a long-term investor with a multi-generational time horizon. And over the long term, and this is as of fiscal year end, June 30th, our annualized investment returns vary. We exceeded 8% for the 10-year and the 30-year numbers, but fell short of the 7% discount rate for the 20-year and the 5-year numbers, coming in at 5.5% for the 20-year, which of course includes the Great Financial Crisis, and coming in at 6.3% for the 5-year time frame. And as mentioned, this really points out how different performance can look depending on the time period used, which again speaks to our focus on the long term. In fact, if you fast forward just 6 months to calendar year end, December 31st, and the numbers that Marcy talked about yesterday, the performance looks very different, being actually 12% for the 1-year calendar year, as opposed to the fiscal year of 4.7%. And even at 5%, performance jumps to nearly 10% at calendar year end, relative to the 6.3% you can see on the slide here. Now out to 10 years and 20 years, it's very similar, coming in at 8% for 10 years and 6% for 20 years. Again, similar to what's on the slide, and again, underscoring our long-term focus as these short-term fluctuations balance out. Now on the right side of the slide, you can see the performance of the different asset classes. And as mentioned, looking at short-term numbers can lead to inaccurate conclusions here also. Take private equity, for example, which is a critical part of our strategy, and we'll talk more about that later. For the 1-year number, it has the lowest return, coming in at a -5%. But at 5 years, it's tied for the best performing asset class, and going out to 10 and 20 years, it's the highest returner by a margin, again, underscoring it as a critical part of our portfolio. And this is a clear example, again, of why we take a long horizon approach in assessing investment performance. So now that we're looking at the performance of the various asset classes, it also makes sense to briefly talk about the role that each asset class plays in the portfolio. And first, I'll cover global equity or public equity. And global equity is the publicly traded stocks in the portfolio. They represent approximately half of the plan's assets, and the goal here is to harvest what is called the equity risk premium, which means exposure to economic and corporate earnings growth. Here, we're thoughtfully harvesting 2 different return profiles, which you'll see on the next slide, with low active risk and a very efficient cost structure. The efficient cost structure comes largely from internal management, with over 95% of these assets being internally managed and highly cost-efficient strategies with an overall cost structure of less than 1/20th of 1%, or 5 basis points. Second is private equity. And private equity, like public equity, also provides growth exposure, harvesting economic and corporate earnings growth. But unlike public equity, private equity is entirely privately held and not publicly traded. Private equity also provides the opportunity to enhance the equity return of the total fund through an active value-added approach. So compared to public asset classes, private equity may offer higher returns, and in fact, it was the only asset class with expected returns above 7% in our last ALM cycle. But that higher expected return comes with higher modeled volatility and with significantly less liquidity. Next is global fixed income. And global fixed income is the publicly traded bonds held in the portfolio. The purpose of these assets is primarily to provide diversification to equity risk, as well as providing liquidity to the portfolio and an income return stream. Now, like equity, which has 2 segments, fixed income is also segmented with 3 separate sleeves totaling nearly 30% of the plan's assets. Fixed income is also more than 95% internally managed in a highly efficient, value-adding, and cost-advantaged way, with the overall cost structure here also being less than 1/20th of 1%, or less than 5 basis points. And next comes real assets, which includes real estate and infrastructure investments. And like fixed income, real assets is intended to be a diversifier to equity risk. Additionally, it's expected to provide stable and predictable cash yield, as well as inflation protection. Now, like private equity, investments in this asset class are privately held and therefore less liquid than the public market assets of public equity and public fixed income. And the final asset class in our portfolio currently is our liquidity sleeve. And this asset class serves just basically like cash in a checking account intended to meet our ongoing cash obligations. So that gives you a sense of the overall long-term performance of the portfolio and of the asset classes, as well as a sense of the roles that the various asset classes play on the portfolio. Next, we'll go through a 1-year snapshot of the Public Employee Retirement Fund, or PERF, as well as how the portfolio is allocated. You have the next slide, thank you. Okay, so on the left-hand side of this slide, you can see that as of fiscal year end, June 30th, the portfolio was worth nearly $400 billion, resulting in a funded ratio of a touch over 70%. Now note that 70% funded also means 30% underfunded, meaning that for every dollar worth in future liabilities that we have 70 cents in assets on hand in the present time. Also note that this funded ratio is one of the many reasons that the investment staff has to stay laser focused on investment returns. Earning 7% in this environment is a very tall order, and that fact, coupled with a funded ratio, is the reason that we must stay focused on generating investment returns, as our mission statement indicated. And at the bottom left, you can see that we ended the fiscal year with a 4.7% positive return, as Marcy alluded to earlier. Now, candidly, a 4.7% return for fiscal year is below our assumed rate of return of 7%. It did, however, reflect a very strong recovery from the negative 4% return that it had been just 3 months earlier, near the bottom of the pandemic-related market sell-off. And this performance also beat our benchmark of 4.3%, and it was reported that many of our public pension peers returned an average of around 3.2%. But it is below our 7% assumed rate of return, which again speaks to our laser focus on generating investment returns. Now, on the right side of the slide, you can see our current strategic asset allocation, again coming from the 2018 asset liability management cycle. Before we get into the details, let's just talk briefly about what strategic asset allocation means. A strategic asset allocation is a target allocation to the various asset classes a fund expects to have in place over a long period of time. And the reason that strategic asset allocation is so important, and as one of CalPERS 10 investment belief states, is that strategic asset allocation is the dominant driver of risk and returns. And we are just kicking off a new asset allocation cycle, as Michael mentioned, which Lauren and Sterling will speak to also in a few minutes. And given the criticality of strategic asset allocation in determining returns, this is a really critical body of work for us this year. For the current asset allocation, which again came from our work in 2018, we have approximately 50% of the portfolio in public equity between the two segments. 8% of the portfolio is intended to be in private equity, again providing similar exposure to growth, though with higher expected returns, but also less liquidity and higher modeled volatility. Nearly 30% of the portfolio is in fixed income across three segments: the U.S. Treasury segment, which provides exposure to U.S. government debt and is intended to be a low-risk, highly liquid source of returns, as well as a diversifier; and two other segments, one spread and one high yield, that again are bond exposure, providing similar risk characteristics, but carrying a higher spread, with meaning higher returns while taking on some additional risk. 13% of the portfolio is intended to be in real assets, and 1% is in liquidity, which again is frictional cash in the portfolio for making ongoing payments. All right, can I get the next slide, please? So that covers where we are currently. And with that, I'll turn it over to Lauren to walk us through some thoughts on economics and markets and how those themes connect with the upcoming work on strategic asset allocation that Sterling will discuss also. Lauren, over to you.
Thanks, Dan. Hello, everyone. So when we consider asset returns that can help CalPERS meet its retirement commitments, it's natural to ask how the economic environment plays into this. And the current economic environment impacts on current asset prices, but so do future expectations of the economy impact on current asset prices. In addition, the future economic activity and conditions impact on future asset prices. So we can separate this into three, what I call distinct phases. So the short run, or the starting point, so that's right now, the coming year to 3, the medium term, or the business cycle, which is 3 to 5, 5 to 7 years in duration typically, and the long term, or the secular sort of drivers, and that's way beyond, 10, 20 years and beyond. So the ALM process and the strategic asset allocation is primarily focused on that very long run, i.e. beyond the business cycle. So when we consider, or when we think about where an economy might be at 20 years or more, you've also got to consider things like the social and political economy, fiscal and monetary policy framework, environmental regulatory structures. So you can see that the relationship between market conditions, market structure, macro conditions, market structure, investor behaviors, and asset returns is not linear. So what questions should we be asking? What's the framework we should be thinking around? And what we do is we use economic trends or secular long-term trends, and we see what some of those drivers are and whether those drivers look like they're likely to change over this 20-year horizon. If we move on to the next slide, you can see that within that, there's the line I want to highlight here is real GDP, or this red line. So real economic activity, which is the value add of the economy when you take out the changes in prices. You can see that red GDP line seems to move in cycles. This is the business cycle, I guess. You can also see that it's lower today than what it was in the past. And this is this long-term or secular trend that I want to talk to you about. And most recently, you can see the drop in activity as the pandemic hit and the subsequent rebound that we're currently experiencing. And this is what I call the short run, or the starting point. So I want to focus on the long run today and talk you through some of the long run economic drivers of secular trends of both economics and therefore into asset price returns. And one of the key economic tenets of the long run is population growth. In the US has seen slowing population growth since the 1960s. We've got lower fertility rates, lower mortality rates, and increased life expectancy. And this population trend, I often call this the super tanker. This population trend looks set to continue, both here in the US and globally. It's very difficult for this to move around in the short run or to change direction. Now, directly related to population growth is labor force growth. And lower labor force growth reduces the growth rate that an economy can potentially achieve. Think of how much you earn and how much you spend. So in a situation of full employment, we have lower labor force growth, and it points to an economy that grows typically at a slightly slower pace. This is also consistent with lower risk-free short-term interest rate, which is adjusted for inflation. So you can see the link there between population, macroeconomy, and to asset prices. But it's not just population, demography also matters. And, baby boomers here in the US are retiring. In fact, in 1960 in the US, 9% of the population was aged over 65. The US Census Bureau are predicting that over 20% of the population will be over 65 by 2040. And this is a theme that we're seeing globally as well, not once again, only just in the US. So this changing demographic picture has implication for many things, including spending and saving habits. I spoke to those briefly before, as well as lower labor supply, so the participation rate of labor into the market. And that also further weighs on the underlying growth rate of the economy. But you might say, we have all this technology, we have all this innovation. Look, I'm talking to you today via Zoom. So, innovation has increased productivity dramatically over the last 100 years or so. What we do see, though, is despite the technological innovations we have had recently and over the last 2 decades, the productivity numbers are higher in the 1920 to 1970 period than what we've seen over the past 2 or more decades. This is what we call the productivity puzzle. If we see higher productivity in the future, for every input that we put in, every unit input, we get more out. So we can grow faster, we can grow at a faster pace, and we can sustain higher interest rates on average. The opposite is true if productivity numbers don't pick up or decline. And the last one I want to talk to is this policy and regulatory environment. And this sort of comes back a little bit to today as well. If there's a large enough economic shock, sometimes the structure of the economy can change. And there are some things that have happened over the last decade or so that point to potentially some changes in this economic structure. For example, in the post-2008 recession, financial services regulation has subsequently increased dramatically. Recently, the Federal Reserve has adjusted its inflation mandate, so it's going to allow for faster price rises in the future before responding by tightening policy. The other one that's often in the news stories is globalization. The shifts in the globalization that we saw in the early part of last century look to be reversing. So more recently we've had trade tensions and potentially a political economy that's less open to frictionless borders. So that suggests the pace of this may well slow. So you can see a lot of these issues that I'm talking about, that economic side, don't have simple fixes that are going to normalize this risk-free rate of return, as it were, back towards its historical average. Rather, they're entrenched factors. They're these cyclical long-term drivers that are likely to be with us for the foreseeable future. I've spoken a lot about activity, and I want to briefly talk about inflation, because activity and inflation are linked. If growth is so strong that it puts pressure on capacity, then prices tend to rise. And that has differing implications for different asset classes and returns. Equities, for example, equity returns tend to be positive when we see positive price rises, in other words, inflation, but not if inflation is too high or persistently higher. When we think about the income returns or bond returns, that's a component of both a real return, an inflation return, and then a risk premium on top. So lower inflation since the 1990s is consistent with this lower interest rates that we've seen over the past few decades. But what it also means is lower inflation reduces the variability of inflation. And the variability of inflation impacts on the premium that investors require or demand to compensate them for holding on to this inflation risk. So you've got two things there that's been compressing interest rates over the last 20 odd years. So together, these act as a bit of an anchor. I want to sort of finish off here and just talk back towards today, because we are in the midst of and coming out of an historically large economic shock. So talking back towards the short term or the business cycle duration, as it were, it's too soon to get a clear sense of the end point for this recovery. There's a lot of moving parts. What we can see is significant resource reallocations occurring within economies, and that, for us as a fund, presents some risk and also opportunities. You know, when I look forward, we see COVID-19 infections. They're not yet behind us, unfortunately, but the speed of vaccine deployment is picking up. What this does point to in the medium term, so over the remainder of this business cycle, is potentially a period of heightened uncertainty. So what I've spoken about today is these secular trends, these long-term drivers of asset price returns. You can get deviations from that in the short term or the medium term due to business cycle fluctuations. So you can deviate from these long-term drivers, but also that the distribution of asset price returns when uncertainty widens changes. So uncertainty changes the distribution of asset returns. So there's a lot of different factors here that go into the ALM process and what we're thinking around. And to that, I'd like to pass on to Sterling, unless there are some questions.
You know, why don't we continue on to Sterling, and then we'll take questions right after the next part. Thank you. Go ahead, Sterling.
Very good. Okay, well, thank you, Lauren, and good afternoon, everyone. So let me start with one of Lauren's key points. The future long-term returns may be lower than those of the past, may be lower for a long time. So our liabilities have not declined in a corresponding manner, and those lower returns mean the balance between minimizing employer costs and ensuring assets available to make benefit payments may have changed. So simply put, our plan may have become riskier. So what does this mean for CalPERS? As Michael mentioned earlier, CalPERS objectives are laid out in the Constitution of California. Most relevant to our asset liability management program are the following constitutional objectives. 1, delivering benefits now and in the future. 2, minimizing employer costs. And 3, maximizing returns and minimizing risk of losses. So those 3 objectives and their risks are linked together. Over the long run, we expect our portfolio to deliver returns, the returns needed to reduce employer contributions. The return path, however, can be bumpy. In normal times, those bumps are not dramatic. On occasion, however, the bumps in returns can be extreme and potentially leading to extreme bumps in short-term employer costs. And if those cost increases are too extreme, even if only for a short time, employers' ability to pay can become impaired. So these return bumps also affect the funding ratio, the ratio of portfolio value to liability value. The portfolio is the source of future cash flows needed to pay future benefits. And an extreme decline in portfolio value could affect the potential to pay these future cash flows. And if the funding ratio drops too low, stakeholders may question the future viability of the plan. So our portfolio choice must balance the need for long-term returns against the potential for extreme outcomes in the short term and the challenges that could result. We must review the balance between an increase in portfolio risk of loss, an increase in employer costs. We'll consider both the risks in the portfolio and the potential risks for employers and beneficiaries. Improving returns while maintaining our current level of risk is challenging, both because the opportunities for doing so are rare and because these opportunities are rarely large enough to make a significant difference. We will watch for these opportunities, and investment makes sense to do so. It's more likely, though, that current risk levels may not support adequate return expectations. If that's the case, then we have to consider increasing overall risk in the portfolio. And we do so by increasing our portfolio exposure to risky assets. We could, for example, increase our exposure to public equities. Public equity markets are large, and we could increase our allocation with little difficulty. We could also increase our exposure to other risky assets, such as private equity and private debt. These markets are more difficult to navigate, and increasing our exposure would take time. It's an area of focus, exploration at the moment, and Dan will cover private assets in a few minutes. In this world of possibly low returns, risk needed to support the current 7% discount rate may be considered too high. If so, we have to consider portfolios with a lower expected return, and in doing so, potentially lower the discount rate. So to choose our portfolio, the ALM program will consider a range of long-term capital market assumptions. We'll develop a set of portfolios, each appropriate for one set of capital market assumptions. Each portfolio will be distinguished by its overall risk and expected returns and its effect on contributions. We'll then assess the performance of these portfolios across the range of capital market assumptions and compare them. And our portfolio recommendation will consider the capital market assumptions used to create the portfolios and the pension plan sensitivities to changes in these assumptions. By doing so, we'll have prepared ourselves for a range of outcomes rather than the lone outcome based on a single prediction of capital market assumptions. So just quickly to summarize, CalPERS has to balance the competing objectives of ensuring sufficient funding to pay current and future benefits while minimizing employer costs. The plan has two key risks, both linked to the performance of the portfolio. First, cost employers deem unaffordable or too uncertain. And second, a decline in the plan's funded ratio and capacity to pay future benefits. In addition, CalPERS portfolio will be designed to balance the need to maximize returns against the risk of loss. Finally, I just want to note that in a world of uncertainty, when we look forward, we need to prepare for the future and different futures rather than trying to predict a single future. At this point, I'm going to hand things back to Dan, who will discuss the private assets.
All right, thanks, Sterling. So yeah, now as we move on to the next slide, we'll look at how the total portfolio comes together, bearing in mind the total portfolio is what pays the benefits. And then we'll also talk about a couple of our areas of strategic focus. First of all, as Sterling mentioned, improving our capabilities and deployment in private assets, these being the assets of private equity, private debt, and real estate. And then secondly, we'll talk about our exploration of potentially using leverage as part of our strategic asset allocation. So with respect to private assets, really we're focused on private assets because in our financial modeling, we found that the risk-return trade-off can be better in the private markets if we implement correctly. And that speaks to what Sterling was talking about in terms of the time it takes to implement. Now, by implementation, I mean, first of all, we need to make sure that we're managing our liquidity so that we're harvesting a premium for illiquidity. But we've also got to use our comparative advantage to acquire the best assets and use economies of scale to average down our costs. And these just take time. Now, we already touched on private equity and the role it plays in the total portfolio, and bearing in mind that it is the only asset class with an expected return of greater than 7% from our last ALM cycle. So really the focus here, again, is on seeing how we can deploy more into private equity and to do so in a consistent and cost-advantaged way. A second private asset area that we're focused on exploring is that of private debt. Now, private debt instruments carry an exposure that is similar to global fixed income or the publicly traded bonds in the portfolio. But being private, these assets are not issued or traded in the open market. Like with public debt, there's a range of borrowers, such as corporates, real estate lending, and consumer debt and the like. And like private equity, private debt has higher expected returns than its publicly traded counterpart. But also like private equity, Those advantages come with the disadvantage of being relatively illiquid, requiring a deep level of analysis and expertise, and they take time to deploy. And the third area of private assets where we're focusing on is real assets that also serve as a diversifier to equity and also provide higher cash flows and an inflation hedge. So as you can see, private assets really are a key part of our strategy. Now, a second area of focus on our investment strategy, and separate from our focus on private assets, is exploring the strategic use of leverage. Specifically, the work here is around first, determining the optimal portfolio that we would own that provides the best trade-off between return and risk. And from there, it's around exploring a decision to possibly borrow money to hold more of that optimal portfolio. Now, the positive side here is that when we hold more of a portfolio with a positive expected return, our expected return inherently goes up. But candidly, this comes with risks, of course, that Sterling alluded to. First, while leverage can amplify returns to the upside, it also amplifies returns to the downside, meaning the leverage not only increases expected returns, it also increases expected volatility. Secondly, we have to be sure that we can maintain our leverage and our risk position throughout market events, including drawdowns, so that we don't exit the leverage prematurely, locking in losses in the event of a drawdown. And we do this by maintaining a long-term investment perspective, again, underscoring our need to be and to act like a long-term investor. And we do this through ensuring sufficient liquidity in the portfolio to navigate market volatility and allow us to maintain our desired risk profile. Can we get the next slide, please? And so the way it all comes together on the asset side is, as Sterling mentioned, to come up with a set of capital market assumptions, and we expect to cover these with the investment committee in June. These capital market assumptions, or CMAs, are for each asset class, and they include expected returns, expected volatility, and then how the various assets are expected to move relative to one another in various market scenarios. From there, we take these assumptions and put together sample portfolios that bring all the assets together in various weights, as Sterling talked about. And these we expect to cover with the investment committee in September. And then finally, after going through all the sample portfolios with the committee, we'll incorporate feedback, and then the board will decide on the desired strategic asset allocation, given what level of risk tolerance the organization has for setting up the strategic portfolio. And this will result in the selected portfolio for our strategic asset allocation. And this selection of the strategic asset allocation is expected to happen in November. So with that, Kelly, I'll turn it back to you to take any questions before we move on to the liability part of the discussion. Kelly, over to you.
Thank you, Dan. We do have one question that came up. It's kind of a long question, so bear with me here. This is from Rich Lee. Good afternoon. As a part of CalPERS Better Assets strategy, the target asset allocation for private equity will be 10%. One of the challenges that CalPERS faces is the competitive nature of private equity investment opportunities, given its projected ROI over the next 10 years. Can you discuss in greater detail how CalPERS plans to address the variance between asset allocation target and actual allocation for this specific asset type? I.e., the current target is 8, but as of 9/30/20, the current allocation for private equity is only 6.6.
Well, thank you for the question, and I'll take a first shot at it, and then if we want to dig deeper, we certainly can. We have our managing investment director of private equity, Greg Ruiz, on the line also that can certainly go deeper than I can. But it's a great question, and it again speaks to what Sterling was talking about in terms of the time it takes to deploy. You know, candidly, we have been inconsistent in the way that we have deployed our assets in private equity, and that inconsistency has resulted in this sort of underweight relative to our strategic asset allocation. And even our strategic asset allocation is probably lower than our actual desired weight if we could get to 10% or even more. So that really speaks to one of the reasons that we're so focused on figuring out how we deploy more, but how we do so while making sure that we don't engage in any adverse selection in terms of bringing too many deals or not as good assets into the portfolio, but then also figuring out how we do so in a cost-advantaged way. So that's really the area of focus of the private equity team. And that's really a real area that that the entire management team is looking very critically at, because we know that it is one of the real arrows in the quiver to try to achieve 7%.
I do see another question coming in. This is David. So I'm going to go ahead and unmute JJ Jelensik. Go ahead, JJ.
Hello. Private equity versus public equity. Can you discuss where the risks are similar and where they are different, how you mitigate those risks, and the relative returns and how you're getting compensated for the risk you're taking?
Yeah, thank you for the question, Mr. Jelensik. Sure, I would say that, as far as the risks.
And Dan, I'm still JJ.
Even better, thanks, JJ. I would say that at the underlying level, the risks are very similar in terms that both are trying to harvest economic growth and corporate earnings growth. Now, in the private equity space, it tends to be smaller companies. It tends to be companies that can have value unlocked through better, sort of better governance, better management, and the like. But those are some of the areas where we're looking at to try to unlock value in the private equity space. So the underlying risks around economic and corporate earnings growth are similar, although certainly there are differences in their different companies, there are different factor returns and the like, but still similar overall risks in terms of the underlying return drivers. Some of the places, though, where the risks exist on the private equity side is that it's illiquid. So once you're in a deal, it's pretty hard to get out of it. The costs certainly are higher on the private equity side. So definitely a place of difference in terms of the partnerships in the deployment model. In the public equity space, if you're in an asset and you want to get out, you can get out. In the private equity space, once you're in an asset, you're locked into that asset for an extended period of time. So as I say, the underlying return drivers, similar. The underlying risk drivers, similar, though with differences. But it is an area of focus, and we do believe that if done consistently in a cost-advantaged way, we can drive returns in the private equity space that are in the public equity plus approximately 150 basis points in terms of geometric returns.
Given the smaller size and typically higher leverage, both of which add to the volatility and the risk, is using a large cap index really the appropriate benchmark to be using?
Benchmarking private assets, whether it's real assets or private debt or private equity, is a challenge, and there's not a panacea there. We have used peer benchmarks in the past. We have used it's called a custom Young Fund benchmark that was a customized benchmark that was intended to capture the effects of the J curve. We have used, and now we certainly use a public markets benchmark, and again, that public markets benchmark does have more large cap certainly than the private equity marketplace. We would love for someone to develop the perfect benchmark for benchmarking private equity, but it hasn't been done yet with a whole lot of very smart brains applied to it. It's a great question. We're continuing to constantly look at our benchmarking in private equity to make sure that we're applying the best benchmark we can. But to think that we're going to come up with a perfect benchmark, I think is probably unrealistic.
Have you been looking at public market equivalents?
Yes, definitely. That's an area that Greg and his team have spent quite a bit of time on, is looking at how we decompose the returns in the private equity assets, and then what that would mean in a public market equivalent space.
Can you give me the pros and cons on it?
What do you mean the pros and cons on public market equivalents?
Well, you don't use public market equivalent for your measurement right now. So obviously there's some downsides to it, but you've also acknowledged there's some upsides. I'm just wondering if you can discuss, the pros and cons of using that rather than a large cap weighted index.
Well, I would say that, using a large cap weighted index is a public market equivalent, right? I mean, we're talking about, the large cap index is the public market. So one of the pros of that actually is that is the sort of opportunity cost at the total fund level of investing in private assets. Investing in private equity, the opportunity cost would otherwise sit in public equity. And that's the reason that we use that public market equivalent. Going to a more detailed and more granular way, certainly there are certainly other ways to do it. As you go into a deeper, more granular public market equivalent way, one of the cons or two of the cons is, number one, that's not the opportunity cost of the benchmark, generally speaking. But secondly, and importantly, it just becomes a much more opaque benchmark, and certainly transparency and clarity and simplicity have a premium for us.
Thank you.
Thank you, Dan, for answering that. We've got one more question that came in. This is from Mr. Dylan Gibbons, who's with the California Special Districts Association. Mr. Bienvenu, what can CalPERS members/member advocates do to assist you and your investment team in achieving your mission and vision?
Dylan, thank you so much for that question. We really appreciate the support. The big thing is to really let us focus on investing. And we talked about, staying laser focused on investing. Private equity tends to have a lot of noise around it. There tends to be a lot of discussion, and a lot of those things kind of get out of the realm that is the investing realm, really allowing us to stay laser focused on deploying capital, deploying it at the best assets, and deploying it at those assets in a cost-advantaged way. Everything that you can do to support us and help us stay focused there, that's really the best support that we can ask for. And as I say, we very much appreciate the support.
Thank you. Can we do this? Greg Ruiz, our managing investment director over private equity, can we invite you to come onto the call here and just discuss how we're moving our private equity asset allocation up the ladder from that 6.6 to our desired asset allocation? Are you able to hop on?
Yeah, I'm happy to.
Please do.
Yeah, and I think, can everyone hear me okay?
Yes.
I would just, reinforce, I think Dan laid it out very well. One of the important features of private equity is just how long dated it is. And so, whereas you can move assets in and out of the public asset classes with great speed, it's really the opposite in private equity. And so, if we want to build an effective private equity program, that's really a 5 to 10 year exercise. And if you look back over the last 10 years, or even 10 to 15 years, what happened was we ramped our program very aggressively in 06, 07, and 08. And then when we hit the financial downturn, we dramatically reduced the capital we committed to private equity for about the next 10 years. And because it's a long dated asset class, it takes time to both build positions and to reduce or expand your exposure. And so because we have under-deployed relative to our targets for about a decade, what we're now seeing is the result of that. And so as Dan laid out, if we want to turn that around and build a program, that's something, a scale program, that's something that we need to do very methodically over the next 5 to 10 years. And what that will require is consistent capital deployment. And so that's kind of whether the markets are bullish or bearish, we need to be very consistent in how we deploy our capital. It will require us deploying in new ways. So one very important way that we will deploy capital is through a co-investment program, which allows us to deploy more capital, but also to deploy it in a much more cost-efficient manner. directly improving our returns. And we'll also, I think, need to kind of thoughtfully increase a little more diversification by investment strategy within the private equity program. So if we do these things, and they're all very possible, but if we do them and we stick to them consistently for the next 5 to 10 years, I have every belief that we have a pretty enviable set of competitive advantages given our history in the space and our scale and the relationships we have. I have every belief that we can build a very strong program that performs well relative to our policy benchmark. But again, to Dan's point, it really will take that consistency that candidly we've lacked over the past decade.
Thanks, Craig. A couple more questions came in. They're from the same stakeholder, so I'll just combine them real quick. So from Jose Luis Pacheco, does the investment strategy include hedge funds and CDOs, collateralized debt obligations currently? So probably for Dan or maybe Sterling there.
Yeah, why don't I take a first stab at it, and then if Sterling wants to add anything or others. Let me also ask that maybe we can get Jean forward, because Jean Sue can speak to some of the CLOs and CDOs, type assets. But I'll take the hedge funds. I mean, we made a decision to exit hedge funds, 6 or so years ago, and from my perspective, I don't think we've changed our thoughts on that. Hedge funds are totally appropriate investments for a lot of investors. For us, though, between a challenge around scale and then a challenge around the cost and a kind of an inability to move the needle given the challenge around scale, we as an organization concluded that it wasn't the right answer for us. And one thing, and Greg alluded to this on the private equity side, one thing that we've seen this organization do is move back and forth, and I think Marcy calls it portfolio whiplash. We want to avoid that. And so I haven't seen anything that would cause me to change my perspective on hedge funds, and I don't think the organization has either. And so absent that, I think we'll probably stay where we are. That again, totally reasonable investment for some investors, just not necessarily the best thing for CalPERS. We have other diversifiers and the like. If we have Jean on, maybe Jean can take up the question on whether we're using collateralized debt obligations and how we use collateralized loan obligations and the like.
Hi, can you hear me okay?
Yes.
Okay. So the CDOs in the past is used to describe a collateralized debt obligation, and then the underlying collateral is actually residential debt mortgages, and then they are like just in one area, which is the mortgages that you and me that we will borrow, and then some of those mortgages during that bubble time has a lot of fraud in it. And thus, it caused a lot of problem on the underlying collateral's performance. And thus, the structure doesn't hold and cause a lot of problems in the great financial crisis. So let's say that if we put that CDO into this category, purely in the residential area, CalPERS does not have those assets in our portfolio. And in going forward, we do not plan to have it. However, there are a lot of things which is using similar financial re-engineering technology. They call it the collateralized loan obligation, that is corporate loan underneath it, or collateralized bond obligation is a lot of other bonds like the corporate bonds in it. These are publicly traded securities. So we are definitely able to invest in it. But again, when you invest in structured products, very important thing is understanding the actual behavior of the underlying collateral. Collateral behavior plays the most important thing for you to either earn your expected return or possibly that you may lose your money. So when we are engaging in this structured product area, we'll be extra careful, number one, in the underlying collateral, number two, the diversification of the collateral, and then number three, the structural protection, as well as the number four, that we will have languages around the document to regulate it. And within this collateralized loan obligation or collateralized bond obligations, there are different tranches with different risk reward profile to it. Some of them like rated AAA and have a very positive and very stable cash flows. Those we can use as a cash enhancement. Some of them in the mezzanine classes is much more of almost like a hedge fund strategy. And then some of them, like in the equity tranche of it, it has high return expectation and it historically has been performed pretty good, right around like the low teens to like the financial crisis. They can perform all the way up to like 20% IRR. But those has a different risk appetite to that. And we have to use it carefully to see if we want to put it into CalPERS portfolio. At the end of the day, those are highly leveraged structure at the equity tranche. And then those may cause, given the inherent leverage, cause huge price volatility into that. And then all it comes back, we want to have all the tools available to us, but we need to be very careful in selecting the collateral as well as selecting the structure, and then size our appetite right to choose the right tranche for the right risk return. Thank you.
There's a follow-up question on that. What about MB as in boy S secured by Sallie Mae?
Can you say that again? What is that?
I assume it means mortgage-backed securities secured by Sallie Mae. What about those?
Sallie Mae, as far as I know, is usually is Fannie Mae and Freddie Mae and Ginnie Mae are mortgage-backed securities. Sallie Mae historically refers to student loans. So I'm not sure.
You're right. So it would be. I think they meant Fannie Mae.
Okay, Fannie Mae. Okay, Fannie Mae and Freddie Mae, they're mortgage securities. Those are very liquid. It's almost equivalent to the treasuries. And in some situations, it's even more liquid than the treasuries. And in the mortgages, they have the TBA market, to be determined market. It is like it's a roll market. It's almost like a repo in the mortgages that is trading in like, billions and billions every day. Those actually is a very good liquidity source for the for CalPERS liquidity portfolio, it's very well used. People usually lump them together with treasuries in the same risk profile. So hopefully this answers the question.
Yes, thank you. So Kelly, I'm not seeing any more questions. Back to you.
All right. Thank you, David. Thank you, Dan, Jean, Greg. Appreciate your comments there. We'll move on to the next portion, and I'm sure we'll be back to you folks. For our next section on the L, or the liability, we have our Chief Actuary, Mr. Scott Tarando. Scott?
Thank you, and good afternoon, everyone. Next slide, please. Thanks. As you're aware, most public pension plans employ an actuary to do an annual valuation for their system. And what this annual valuation does is it helps present the liabilities, accrued liability, the plan. It looks at the funded status, and it also presents the funding requirements for the system. In order to do this valuation, there's a lot of complex data that's involved, as well as a number of various assumptions. These assumptions, are based on future projections about future events. So these selections, are a critical part of the valuation. Properly chosen, they can help the stakeholders understand the future financial conditions, and it helps ensure the sustainability of the system. So what are some of those assumptions? Basically, there's two groups. We have the demographic and the economic assumptions. If you look at the demographic ones, they're mostly related to the pension plan's membership, such as future rates of retirement, turnover, disability, and death. On the economic side, they're related more on the other type of factors, such as future rates of investment return, inflation, and pay increases among individual participants. In addition, the actuaries will make some additional, more minor assumptions, such as rate of retirement, rate of marriage, rate of benefit selection, and on the optional side as well. Next slide, please. So how are the assumptions chosen? It's important that that we continually monitor what's going on in the plan, the experience that it has, as well as reflecting future events and anticipation of what's going on. The selection process is basically guided by a number of actuarial standards of practice, or commonly referred to as ASOP. We're not going to go through the particular details of those ASOPs. If you guys find yourself with some extra time, you can go to the American, the Actuarial Standards Board and look through them. There's three main ones I think you'd want to look at. There's number 35, which governs the demographic assumptions. Number 27, which is the economic assumptions. And you should probably look at ASOP number 4 as well. It's a general standard that covers the measurement of pension obligations. So when you think about the actuarial assumptions, they're intended to be forward-looking. They're expectations for future behavior. And the goal is to reflect that intention. We do look at historical information when we're looking at the past, but we definitely want to consider trends, external conditions, as well as future projections. Now, for public pension plans, how do we approach this? The actuaries tend to review experience and look at conduct what's called an experience study. Next slide. So the experience study is basically the process that the actuaries use to develop either new assumptions or adjust current existing ones. They're performed generally every 3 to 5 years. For CalPERS, we look at them every 4 years. We look at varying periods of experience, anywhere from, this example here says 4 to 12 years. We want to definitely reflect current trends, but we want to make sure we don't get a lot of noise in any one particular year or a spike. I think this morning session, a question came up, how was COVID and how would COVID deaths impact the mortality, and how do we reflect that in the experience study? The experience study we're doing this year includes data through 6/30/2020. So for the most part, a lot of that information will not be included in the upcoming experience study. But secondly, you want to think about it, we take a long-term approach. So, while there may be a spike this year in deaths and mortality, we want to look at on a longer term basis. Maybe this year's a little bit higher, the following year might be a little bit lower. We'll take that in consideration. If it's a consistent trend where deaths are higher every year for the next several years, we'll factor that into our projections. If it's a 1-year spike that drops and averages it out, we won't necessarily reflect that in any experience going forward. Next slide, please. So the discount rate or the expected investment return, I think, is where all the attention is these days. When you think about it, it's based on long-term returns and composed of two parts: inflation and the real rate of return. Inflation, I think everyone's familiar with, it's a general increase in prices, across the country year over year. On the real rate of return, you can think about it as basically the difference between the nominal return, the returns that you get on any particular asset class, and you subtract off the inflation or divide by inflation, and you'll get the real rate of return. It's important to consider that when we look at and develop the discount rate, we're looking at a number of things. We do take past history into consideration, but there's a lot of volatility in that. If you think about during the 1990s, the returns were really high, no matter where you invested, the returns were fairly well established. That may not be something you want to plan on funding a pension plan. Likewise, we had the financial crisis that occurred, the Great Recession. Those are also other events that, given what's going on, you don't necessarily want to plan on setting a discount rate based on those one-time events. You want to be a little bit more even-keeled when we set the discount rate. And we also want to make sure that we reflect future expectations. To be honest with you, it's more relevant what we get in the future than what we get in the past. We may have a great year this year, or we may have a poor year in previous years. And while it definitely impacts contributions and where the fund is, we need to take a more forward-looking approach when we develop the discount rate. So, to kind of summarize where we are with this, you think about the assumptions, the actual assumptions, they're forward expectations used to help establish our contributions and the funding requirements. The experience study is a process by what we select those assumptions. And when you think about it on the economic side, that currently, they're really being affected by the current low interest rate environment, the low inflation, and that's putting a lot of pressure on possibly lowering discount rates, for not necessarily for pension plans across the country. Assumptions, I think you think about it, they are very important. If they're not correct, you'll have a misfunding of the plan, and it could lead to some decisions about future actions that are that lead to misplaced expectations. So next slide, please. Now, I'm not sure, David, if you want to stop here for questions before we go to the next section, or just wait and have the questions at the end.
Sure, we had one come in that I think is relevant to what you just talked about there on the discount rate. So this from Rich Lee: other state pension plans have discount rates that differ from their long-term expected rate of return. Is this separation an option that CalPERS staff will be presenting to the board for their consideration during ALM? It may require Michael on that one too, but.
Yeah, well, I'll speak to this, and then if Michael wants to add a comment, that's fine. Currently, the board policy, it's a board policy that the return or for the discount rate is set at the expected rate of return. In the past, CalPERS actually had a difference between the two. We had what was called a margin for adverse deviation. It was around 25 basis points. And basically what that was the expected rate of return on the investments is say 7%. The discount rate would have been set at 6.75%. We had this margin several years, in existence for a while, but a number of years ago it was removed. There was a combination. There was pressure on returns coming down, and this was a way to avoid dropping the discount rate. And also another thing to take into consideration is when Pepper passed, you have the split of the normal costs between employers and employees. And if you are going to set the discount rate lower than the expected return, that's going to, obviously add additional cost, both on the employer side and the employee side as well on the normal cost side. So that's something to consider, another consideration in terms of why you would or wouldn't want to necessarily have a discount rate different than the expected return. Some plans have them, some plans don't. It is something that we can bring up to the board if there's some interest in it.
Thank you. There is another question, but I think it's going to be one that's more relevant for the very end once we have all the pieces of the puzzle put together on the A, the L, and the M. So I think that's it for questions for right now. You want to continue on, Scott?
Yeah, let's go to the next slide. So combining, we talked about the assets, we've talked about the liabilities. Now, part of the process is combining them both and taking a look at them jointly. So, one of the considerations we look at is, as we have here, maximizing investment returns, not this singular goal. It's what, we want to get, the maximize the investment returns for a given value of risk. But there are other things in consideration. I think Sterling, discussed this. We talked about the volatility of the fund and how that translates into, volatile employer contributions, and can the employers handle that volatility? We look at that as one consideration. Drawdown risk is another, and even liquidity. The point here is when we're looking at the assets and the liabilities, we're trying to make sure we look at all parts of the situation. We're not necessarily looking at one particular goal. We're trying to provide, a stable analysis for the whole system. Next slide. Some of those factors that are driving these risks, plan demographics, plans are maturing. If you think about CalPERS, the system's been around, over 70 years. And the amount of liabilities and the assets in the plan, have reached, extremely large proportions. We have over 400 billion in assets, and the liabilities are much larger than that. Employees living longer, you have increased cash flows, and all this, adds, volatility to the system in terms of, impact on contributions, where things are with ratios to budgets, and so forth. When you think about it, if you have assets of 100,000 and you have your budget's several million, you can have a loss on the assets. It's not going to have a big impact on your budget. But when your assets start to exceed your budget and your annual budget, and you have losses on those assets, that translates into extreme volatility on employers' contributions for the year and on their budget constraints. Current market conditions are also a consideration. Valuations are, extremely elevated right now, and just the general level of volatility in the market itself has increased over the years. Next slide. And finally, when we look at some of the things we consider when we look at the assets, is we look at, we try and run through a number of scenarios, and we try to measure what's the impact. We look at funded status, required contributions, and that volatility. We try and run through the various asset classes, the portfolio selections, and a number of stochastic simulations, so we can kind of get an idea of what will happen. I think the one thing we do know is, our assumed rate of return right now is 7%. We may get that one particular year, but it's extremely unlikely. And I would say it won't happen that we'll get 7% every single year. So you're going to have variability. So what we do is when we look through these scenarios and we're testing the various portfolios, we want to see how much variability it has and where does this volatility center around in terms of expected returns, contract employers, and employer contributions. Next slide. And finally here, just want to, a little plug here for the CalPERS Pension Outlook tool. This is a free tool that's available on the website for everyone. They can go in and they can run a number of different interest and investment return scenarios. They can change the discount rate and they can see what the impact is on their particular plan. And as we go through this ALM process, if you have questions on how will something in particular impact me or my plan, this is one way that you can go out and see the impact directly for your particular agency. And with that, I think we'll open up for some more questions.
Thank you, Scott. So again, folks, if you have any questions or comments, do feel free to raise your hand using the button at the bottom of your Zoom panel, or you can type one into the Q&A function. We've got one that's still more appropriate for at the end of Michael's. Seeing no questions right now, Scott, I think you're off the hook momentarily. Back to Kelly Fox.
All right, thank you, David. So for the final portion here of this session, we'll turn it back over to our CFO, Mr. Michael Cohen, to discuss the M, or the management component of the ALM cycle. So we'll flip it to you, Michael.
All right, thanks, Kelly. So again, the financial office's role is really to bring the investment office and the actuarial office together in this process and sort of put them together to ultimately provide the board a recommendation in terms of what they should be looking for as an asset allocation and ultimately a discount rate. So if we go to the next slide, this is really a reminder of the timeline I showed you earlier in terms of just what's coming up in the next 6 months or so. So next month at our February board meeting, the investment committee will be delving further into the ALM concept, as well as providing more sort of context to this overall process. We are going to be having quarterly webinars, much like this one. So you can mark on your calendar April 27th as our second quarterly ALM update. We'll have another two later in the calendar year, and David and Kelly's team will provide details on those as we get a little bit closer. And then finally in June, as you heard from our investment team, they will be providing to the investment committee the capital market assumptions to the board. And so with that, let's go to the next slide. And this one really needs a little bit of background. In October, when we held our educational forum for employers that we do every year, we got a question regarding what we're calling a split fund. And the context for it is we've had a number of local government agencies over the last few years really put a focus on paying off their unfunded liabilities. Either they're using 115 trust, which lets them build up assets over time and then transfer them over to CalPERS. They're making one-time large discretionary payments, or we've seen a number of agencies, particularly in the last year with low interest rates, turn to pension obligation bonds as the funding mechanism to make these large payments. So they have the benefit of bringing an individual local government's funded ratio up closer towards 100%. And as a result, though, those that have issued pension bonds now have sort of fixed debt costs in addition to their annual pension obligations. So we got the question in terms of, well, we've done this at our local level, and we're really interested in having less risk than the board in terms of investment expectations, and with that, sort of less volatility. And so the question posed to us was, well, could we choose to have a lower discount rate than ultimately decided by the board? And this is something that really is at the heart of the ALM process in terms of stakeholder input. We're interested in knowing from local agencies if this is something you would consider. And so you've got the email address on the screen that you can either provide us feedback today or follow up. For those of you who are catching this in rerun, we're also happy to take your interest in this. I should say, as with everything in the pension world, there are trade-offs of going towards a split fund. Most importantly, if you were to choose a lower discount rate, immediately your funded ratio is going to decline and your fixed costs on an annual basis are going to go up. The thing you would be trying to eliminate is the volatility of unfunded liabilities, that if you have a lower target of the discount rate, you're more likely to hit that level, and so you're more likely to have stable costs. But there certainly are some trade-offs in terms of known costs changing, as well as your funded ratio would drop back down. If you're interested in pursuing this option, there's certainly, as Scott just mentioned, the Pension Outlook tool on our website, which would give you a sense, say, based on our current 7%, if you took it down to something like 6%, what you might be looking at. This is something, as far as we know, that's never been done in an American pension system. So it would take quite a bit of technical work to get it up and running. And so it's not something that, given all of the effort, if there's only one or two agencies out there that think they would likely pursue this, it probably wouldn't be worth it. That being said, if there's sort of a larger number of agencies that are interested in going forward, it is something that we can continue to pursue internally and give you updates at the future webinars in April in particular. So with that, let me pause and turn it back to Kelly and David. I think it looks like we've got some more questions.
Yes, thank you, Michael. So let me go to the couple questions here specifically for you. Again, it looks like we've got a couple repeat ones. David, are you seeing the same thing here?
No, I see some new ones.
Okay, why don't you go ahead then? I see some old ones here.
Okay, so this one comes from Rich Lee, Michael. So year-to-date ROI for the investment portfolio is 12%. If the fiscal year were to close today, the risk mitigation policy would be in effect right now, and the discount rate would be reduced by 5 basis points. Is there any discussion of modifying this policy through the ALM process, or if the outcome of the current ALM process is a decrease in the discount rate, would the risk mitigation policy be temporarily suspended again? And maybe that's Scott as well.
Sure. Let me take the first shot, and then Scott can feel free to chime in. As Rich notes, the risk mitigation policy is in effect. That being said, I don't think there's going to be any change according to that policy without understanding that we are going through the ALM process. So I think the bottom line is we're aware this policy is in effect and it could come into play in this fiscal year, but we would want to make sure the board was aware of the interactions between its coming decision in November as well as that policy. So let me stop there and see if Scott wanted to add anything.
Yeah, I agree with what Michael said. It wouldn't make sense to, I think, if the policy kicked in, to have a recommendation on a discount rate that the board's going to be adopting a month after this particular policy would kick in. It seemed we'd want the policy to be coordinated with any work that we do with the ALM, and obviously I think we would just take that interaction to the board during the ALM presentations that we do throughout the year.
Good, thank you. So this one's for Scott. Is the pension outlook tool available for pool plan participants now?
Yeah, it's available for both pooled and non-pooled employers. I think it was the pooled. I'm not sure exactly when it was available for pooled plans. I want to say it was sometime in October. So it's been available for pooled plans for a number of months now.
Very good.
We've got a question here from earlier that we put off till now. So JJ Jelensik was asking, Scott, can you discuss the development of expected asset returns for years 11 through 30?
Similar to the process that we use and the investment office uses to get returns, the expected 10-year returns. We will go out and we'll get forecasts or expected returns from a number of investment firms out there. If you go back several ALM processes in the past, it was very difficult to get those forward-looking expectations. They would provide the 10 years, but they would never really go beyond 10 years. You'd have one or two that would provide maybe a 20-year. Nowadays, you will see a number of firms providing results for 20-year and 30-year expectations. And so that's our process on how we're going to get those expectations. In addition, if you look at out on the web, Horizons Actuarial does an annual survey, and they provide both 10-year and longer-term 20 and 30-year expectations. And they get a survey of over 30 firms, investment firms, providing those expectations. And so, you know, there are a number of sources available to generate those expected returns. You know, as actuaries, you know, we want to look long term, but we're not necessarily investment experts. And so, we're going to be leaning on the investment profession to provide those expectations in terms of long-term returns as well as on the short-term side.
All right, thank you, Scott. So this question is a little longer one, and he admits initially that it's not necessarily an ALM question, but I'm going to go ahead and fire it away since we have our specialists here with us. So from Chad Rindy, not necessarily an ALM question, but CalPERS offers a variety of tools for employers to proactively address their pension liability, such as additional discretionary contributions, shorter amortization periods, and Section 115 trusts. However, some of these tools are limited utility to county employers that participate in CalPERS, as the superior courts are commingling in county pension plans, which goes back to the Trial Court Governance Act in 1997. However, these are two separate legally distinct employers. Has CalPERS looked into facilitating separating the plans to allow use of these proactive tools? So maybe Michael can start there and
Sure, I'll start and say in my 2 years, this is the first time the issue has come up. So it's to answer your question directly, no, we haven't, as far as I know, considered separating. But I will say from my prior experience, this is not the only sort of remnant from trial court funding in 1997 that never really got cleaned up. So it doesn't surprise me that the issue is being raised. It's something I'm happy to follow up on and see if there's impediments to what you're asking.
All right, thank you, Michael. And David, I think we'll hold off on Dylan's question till we get through this section.
All right, so I think Kelly, just kind of winding down towards the end, this is your part right here.
Okay. Well, we're here to help you.
You asked for that.
Yep. So one more question here, and this one goes back to Dan. Bienvenue. So Dan, sorry for the tough question, but are there any examples of CalPERS rules, requirements, board handcuffs that hinder your ability to reach the 7% investment goal, i.e., what manufactured rules hinder your ability to reach the desired goals?
Right. Thank you for the question, and no, no concerns about it being a tough question. We certainly want all the questions, so thanks. I can't think of a specific rule that's out there that's like that. I would say that, there was some noise around when we wanted to raise the policy, the overall total fund policy leverage limit to 20%. There was some noise about that, but ultimately we got there. We wanted to make sure that that didn't become a self-imposed binding constraint of some sort. We talked about, and I think it was November, we talked about the predicted tracking error and the way that we're measuring predicted tracking error on the total fund, and that can provide kind of some, unintended incentives. And so certainly that's something that we're going to explore going forward. It's not a constraint now, but it's something that we want to make sure doesn't become a constraint. But I can't really think of any specific rules. I would say that the big thing for us is understanding that some of the asset classes that have highest expected returns, specifically the private assets and specifically within that private equity, tend to also have a lot of noise around them. And we need just help ignoring that noise, or not ignoring, but certainly staying away from that noise and allowing us to stay focused on allocating to deals that can be accretive towards earning the assumed rate of return. So that's one of the real things that we could use your support on, is helping us to avoid some of the noise. Also, I would say to the extent that, sometimes these topics take on political implications, and helping us, keep them out of political implications and instead focused on the investment implications. Because at the end of the day, ours is a fiduciary role. And, as we've been talking about, trying to earn 7% in an environment where we are with, interest rates where they are, with valuations of, equity valuations in the public markets and private markets where they are, that's a tall order. And so just allowing us to stay focused and avoiding some of the noise is another real key area. And then I think that the final area would be just really making sure that we have a collective alignment around what comes out of the ALM process, and then we're collectively aligned and supportive of how we go about trying to achieve what we're trying to achieve. I would say those are the main things. So, again, thanks for the question, and thank you more importantly for the support. And I don't think there's any specific rule that poses a problem. I would just say that, that alignment and that making sure that we can stay focused on the investment outcomes, despite some of the noise around some of these areas of the portfolio, is the ideal.
All right, thank you, Dan. So as we go to the close here, let me again refer everybody to our email address here for any questions, concerns, comments, redirects. Our CalPERS _stakeholder_relations at calpers.ca.gov. That's our contact. You reach David Takeharts and his team, and he's very adept at getting those questions to the right people and getting the responses back to you. So we also have in we have some public comment coming up, but we want to point out, I'm going to flip this to David for a second. He's going to point out, we have in our slide deck here some additions in our appendix that I just want him to point out to everybody that you have in your deck that you've been delivered.
Yes, thank you, Kelly. So just skipping forward a little bit towards the end of at the very end of the slide deck that we're showing, and it's also publicly noticed on the website. We do have an appendix that has some useful definitions of the key terms that we've been using here. I know some of this is familiar to many of you, but it may be slightly Greek to some of you. So here's just like some fairly clean language that could be used to help explain what is being discussed as relates to the ALM process for your members, for your organization. So we've got key terms and kind of like what is being described here. And then we also have a chart that many of you may have seen before that charts out the growth in the liabilities of the fund over time and the growth of assets too. But you can see that the light blue bars far exceed it right now. So just a useful chart that kind of some historical developments over the prior decades. So this is something that many of you again have seen in previous decks and board items, but just want to point that out that that's available for you there. So at this point, I'm not seeing any more questions coming in. Actually, I do have one more question, and it's for Dan Bienvenu. Is there anything specific that we can do as members to assist you with private equity? So kind of along the same lines from Dylan there. What assistance can be offered to help our goals to get that asset allocation where we want it to be?
I really appreciate it. Again, I appreciate the support. The big thing would be allowing us to, to do our jobs, to stay focused on the investment outcome and stay focused, as part of that within the private equity team, stay focused on being able to allocate capital where we want to and we need to, and that we think will be accretive towards 7%. And then when that, when you hear noise around certain parts of the portfolio, and certainly throughout, 2020, we had noise around, different GPs and the like. Remember that the private equity industry, like any industry, has a varying degree of actors. And frankly, there are some, some not helpful behavior that happens in that industry, but there's not helpful behavior that happens in every industry, including public equity, including fixed income. I mean, certainly there have been challenges around all parts of the portfolio, and our job is to try to navigate those things and expose the assets to risks to try to earn 7%, but also know that there's actually a lot of really good things happening in the private equity industry. So the more that we can, as I say, keep the noise out, keep the politics out, and keep the team focused on investing, that's really the best support that we can ask for.
Great, thank you. We do have one last question that just came in, and it's going to be Tim Behrens. Tim, I'm going to unmute you. Go ahead, sir.
Thank you, David. I don't have a question, I just have a comment. I really want to thank all the CalPERS presenters today, and David and Kelly and the IT staff that kept this as smoothly running as possible. A very informative, excellent professional presentation. CSR looks forward to continuing our partnership with CalPERS and the CalPERS board and helping us to meet our mission, which is to protect our pensions and healthcare benefits. Have a good day and stay safe.
Thank you, Tim.
Yep. Thank you very much, Tim. So at this point, we are at our time frame for public comment. So we'll open it up for public comment if there is any. Open it up to our Zoom community here first, and then after the delay, if there's any public comment from our webcast. We do have one comment here from Carla Held. Thank you to all the presenters. This was the first time I attended online. It was a great experience. From Carla Held, CSEA Schools. Thank you, Carla.
Kelly, I'm not seeing anyone wishing to offer public comment in the Zoom. So Renee, is there anybody wishing to offer public comment who's watching the board webcast? I think our connection may have been severed there. Renee or Shauna, are you able to connect in? Can you shoot me a text then to confirm that whether or not we have somebody?
Shauna just sent me a message, David, saying there are no comments.
Great, thank you, Josh. All All right, back to you, Kelly.
All right, David, thank you very much. And so in conclusion here today, I would like to thank the board for allowing us this opportunity to create the Stakeholder Forum. It's our second time, our first virtual. We know that we try to do our best. We know there are some glitches that happen, but we want to thank you all, thank the board, thank our CalPERS team members, in particular our CEO and our executive team for their participation and their help in making this an event that's well worth the time of all the participants. So to all of you who have joined us, thank you very much. Enjoy your rest of your evening, and thank you for being with us.